Hello and welcome to Moneylife News and Views. I am Debashis Basu. Just one share of MRF, which earlier used to be called Madras Rubber Factory, a blue chip tire company, is trading at over 78,000 rupees. Just one share. Now this makes a complete mockery of public listing. This company is listed in the stock market because it is mainly institutional investors who can buy this share with such a high unit value. An individual cannot buy maybe more than one or two shares of MRF, if at all. MRF, of course, you can say is an extreme example. It's the costliest unit value of shares that are listed in the Indian stock market. And this 18,000 crore turnover company has refused to issue any bonus shares or even split its shares from time immemorial. That's almost 30 years that I've been watching this company. The face value has remained at 10 rupees. Regular bonuses and splits would have brought the unit value down and maybe to a low 4-digit figure, maybe 2,000, 3,000 rupees. That would still not solve the huge problem that has been growing over the years, and it needs to be addressed soon. And it's not just about MRF. The problem is a quaint Indian idea called face value, which is putting high performance companies, because the unit value of the shares keeps going up, out of the reach of retail investors. Now here is some data. While one share of MRF is over 78,000 rupees, that of Honeywell Automation, another blue chip company, is nearly 46,000 rupees. How about Page Industries, which a satisfied buyer of jockey undergarments may want to buy? Following the legendary investor Peter Lynch's advice on buying stocks of companies that are within your own circle of competence. You like the product, you buy the stock. That's a very popular notion. A single share of Page is close to 38,000 rupees. And here are some other popular high quality companies with huge approximate unit values. 3M India is 26,000 rupees, one share. Abbott Laboratories, 23,000 rupees. Nestle, 19,000 rupees. Bajaj Finserv, 17,000. And Bosch, 17,500. At Moneylife, we categorize companies as mega caps, large caps, mid caps, small caps, and micro caps. I just did a quick analysis. We cover about 1,800 companies or so. I did a quick analysis and found that almost 92 of mega cap companies and 85 of the large cap companies, these are the two segments that include many of these high quality stocks that I just talked about. These are trading 92 of mega cap and 85 of large cap. These are trading at 4-digit figures. Now this dampens our efforts to widen retail participation, and the problem will get only worse as time passes. Under the Companies Act 1956, Indian companies had shares with a face value of 10 rupees and in some rare cases like ACC of 100 rupees. At that time, companies were allowed to convert their face value of 100 into 10. In 1999, during the dot-com boom, tech companies convinced the market regulator and the finance ministry that India has been living in Stone Age. We need stock splits. And so companies were allowed to split their face value into shares of either 1 rupees, 2 rupees or 5 rupees. This was a concept of 1999, that is almost 22 years ago. And since then, companies have been splitting the shares, but the concept of face value was not dispensed with. That has remained in place. So as an aside, at the height of the dot-com boom, Z shares were spectacularly rigged up to 1,500 rupees of face value of 1 rupees when it was quoting at a P of 250. The catchphrase in those days was 10 ka 1 or 1 ka 10, which means that 10 rupee face value of shares would be split into 1, that is 10 ka 1, and 1 rupee share will become 10,000 rupees, which is 1 ka 10. When the face value is split, the number of shares go up by the same ratio, keeping the equity capital intact. Now, some 22 years have passed and numerous companies have split their shares, which reduce their unit value and increase their accessibility to retail investors looking for good quality scripts, but a problem has remained. Outstanding companies, which retail investors ought to be buying, and I've named some of them, steadily improve their profits over a period of time. Since stock prices follow earnings, the share price keeps rising. Atul Limited was a 3-digit stock in early 2014, or just over 400 rupees or so. It has now hit 5 digits. It can split its stock down to 1 rupee, but the inherent problem of rising unit value will remain. It will become 1000 rupees and again start rising. Once a company has split its stock down to 1 rupees, it cannot split it any further. The only other way to reduce the unit value is by issuing bonus shares, but that may not be desirable from the company's point of view. It increases the capital and has all sorts of implications about how much dividend to declare and how much of cash flows should go out as dividend. We need to make the unit value of stocks smaller without changing the capital structure, and the solution is very obvious, which is abolish the idea of face value. Once the face value idea is abolished, companies should be able to subdivide the stock or the capital into any number of shares. Take the case of Bajaj Finance. The stock is quoted at 7,700 and it has an equity capital of 120 crore, that is 60 crore shares with a face value of 2 each. Now, if face value is abolished, it will have the choice of dividing that 120 crore capital into any number of shares. If it decides to have 600 crore shares, the share price would be adjusted down to 770 rupees. Or if it decides to have even more, let's say 1200 crore shares, then the share price goes down even further, which is about probably 365 rupees or so. Now that would make it accessible to many more investors. It will not be a share that only large players can buy. Now, I have talked about till now the question of accessibility, democratization of the capital markets as it's called. But it's more than that. More than 1.5 crore new investors have entered the marketplace in the last 1 year, while prices of good quality stocks have gone higher and higher and higher. We need to give them the tools of sound investment strategy, the cornerstone of which is asset allocation and diversification. These are the 2 most important things in long-term investing. You need to invest a part of your surplus in equities for the long term and diversify across a large number of shares. Even if you have 100,000 rupees to allocate to equities every month, which is even a fairly large sum even today, you cannot buy, let's say, a Bajaj Finance or say SRF, which is now 12,000 rupees a piece, if you want to diversify across 25 stocks. At the most, you can allocate 4,000 rupees to each stock. And all of these high price shares will slowly will go out of your reach. Now, this will distort how you're able to diversify and how much money you can allocate to high quality stocks. Abolishing face value will fix this problem once for all. It will widen stock ownership, increase liquidity, which benefits even institutional investors, by the way, and bring India to the modern age. Why hasn't such an obvious winning idea been implemented so far? Well, who thinks for the small investor? Thanks for watching, and if you like this program, please do subscribe.